Chapter 13 is on market making and delta hedging, and we'll look at this chapter in 6 modules. Module 1 is going to quantify the market maker risk. First of all, what do market makers do? They provide immediacy by standing ready to sell to buyers at the ask price, of course, and also to buy from sellers at the dealer's bid price. They generate inventory as needed by short selling securities. And of course, they profit by making the bid-ask spread. Their positions are determined by the order flow from customers buying and selling various positions, and the market maker is on the other side of that trade, and so their total net position just reflects the trade order that comes from their customers. In this contrast to proprietary trading, where the trades are initiated by the broker or the investor. And the goal of proprietary trading is making a profit through those transactions. Market maker risk is related to the Greeks of the positions in their portfolios. And their goal is to hedge some of those risks and to understand the risk that is left after their hedge positions have been put on. So here's an example in table 13.1, a listing of the Greeks of a call option with a stock initial price $40 strike, 30% volatility, 8% risk-free rate. We'll assume no dividends. And this is a 3-month or 91-day option. So you can see the difference between the Greeks on the purchase side and on the written side. The purchase side, of course, reflects the client or the investor who purchased the call option from the market maker. When they purchased it, they got a price. They paid a price of $2.78, and the market maker received $2.78. On the delta side, this was a point that was made in the earlier module on the Greeks, and that is a call option has a positive delta, but it has a positive delta of 0.58 to the long position, the investor. The delta of this position, having sold the option, the market maker has a negative delta relative to that position. Same goes for gamma. The purchaser has a positive gamma of 0.065. The market maker, having sold that, is short gamma, has a negative gamma position. And finally, theta also reverses, as all Greeks, that the purchaser has a negative theta, meaning that the value of this security, the call option, decreases with time, all else equal. The market maker has a positive theta, meaning their position, which is a short call position, is increasing in value by virtue of its negative value diminishing. Options can be hedged using a delta hedging technique that we'll study in this chapter. If you have a fully hedged position, not only delta but all other Greeks, you would expect to earn the risk-free rate.